13 retirement investment blunders investors, retirees should avoid and what you should know. So I'm going to list these 13. They're going to be in the show notes. I'm going to talk a little bit about them, examples. This comes from Fisher Investments. I got a lot of brochures from them. I chose not to go with Fisher Investments, but they have a lot of good material that I like going through. So let's get right into it. Number one, placing big bets. This is like going in 50% with Bitcoin, or having all your investments in Apple, or maybe even just the Magnificent Seven. Are you diversified? So placing those big bets because you need a little bit more money, and maybe you got started late, but those big bets almost always are a loser. Now, you're always going to hear the one story, the one person who placed a big bet and won. So blunder number two is being too conservative in investing. Hey, you're retired now, stock market can go up, it can go down. I want to avoid all that. Let's just put it all in T-bills and go on down the road. Well, good chance you're not going to have enough money in retirement. If you live, 30, 40 years and end up with some one-time cost or high medical costs. So, what should it be? Should you have, 60-40 in stocks to fixed, 70-30, 50-50? But being too conservative is a very frequent blunder, according to Fisher. Number three blunder, falling for a Ponzi scheme. This is somebody that promises 12% returns every year. That was what's the guy's name? I can't remember his name. Not Ponzi, the other guy. I'm sorry about that. But a Ponzi scheme. If somebody's promising high fixed income, be wary. Okay. Blunder number four: paying excessive fees. But returns don't grow on fees, I think is the little phrase. But if you're paying 1-2% for mutual funds, and then paying 1.5% for an advisor, you could be 3% a year, and that's a drain. Whether your stocks go up or your stocks go down, or if you're in bonds, returning, 3-4%, and you're paying an advisor 1%, and you're paying 0.5% for the privilege of buying that. That's 1.5 out of 3 that you're paying. So really watch fees. Blunder number 5 is ignoring inflation. Big deal. How are you going to deal with inflation? Don't just hand wave that, saying it's not a big deal. Number 6, relying on common knowledge. This is, hey, 100 minus my age, I should have in stock. So I'm 60 years old, 100 minus my age, I should be 40-60 in my portfolio. That blanket rule may apply to some people, but not to individuals. Another one is like, hey, you should be 60-40 and rebalance every year. All these rules of thumb. The 4% rule of thumb, be careful with that. Number 7, trying to time the market. You've heard this. I don't need to give examples of that. I'm going to say valuations are too high. Let's sell everything. Our debt's too high in this nation. I'm going to sell everything, wait on the sidelines. Everybody knows what happens with timing the market. You got to time it twice, right? Out and in. And then if you're right, you got a lot of confidence. You try to do it again and get burned on it. You only hear stories of the people that timed it well, not the 99% that timed it poorly. Blunder number 8, buying gold and other commodities. Gold, when it does well, everybody talks about it, everybody advertises for it. I get asked once a day to advertise gold. I do not buy gold, so I do not recommend gold. I don't have a link for gold. But it's been doing great, but it doesn't take too long of a history test to look at how poorly it's done over longer periods of time. And you need it to perform during your 15 years, your 20 years, your 30 years of retirement. Anyway, number 9, buying annuities. Ken Fisher's organization hates annuities because it locks you in. Most of them don't have an inflation rider on there where they're adjusted up for inflation. And investing in the stock market has historically produced better returns, but I'm not against annuities. I don't have them. I do look at them. I do study them, but so far have not made that choice. It is basically buying an insurance product to lock in guaranteed income. And it removes fear. You're paying to remove fear. You're losing some opportunity cost to remove fear. That could be a great decision for you. It's like buying a pension, okay? Blunder number 10, mismanagement of withdrawals, not having a withdrawal plan with taxes in mind, not managing taxes at all. Number 11, ignoring international stocks. I have a graph in here that shows in the 70s and 80s and the 2000 to 2010 time period, international stocks did a lot better than U.S. A lot of you are saying and justifying, hey, I buy Apple. Apple's an international company. Well, there's a lot of companies that aren't homed here in the United States that are good companies. It's kind of naive to think only good companies are based here in the United States. And like I said, if you look at the chart of 70s and 80s, I'll see if I can link it somehow in here. I'll take a picture of it and put it in the show notes. The 70s and 80s, internationals did a lot better. And the 2000 to 2010, a lot better, okay? That'll never happen again? Well, maybe not. Number 12, letting political beliefs drive your investment decisions. Guys, I just left a video on this. There's always been politics. There's always been drama. There's always been one person making a change and one party making a change that everybody thinks this is the next great recession, this is the next depression, this is the next stagflation. History doesn't, the history of the stock market doesn't care, really doesn't care. Could be a momentary blip and oh my gosh. I think we're in that now, maybe not, maybe I'll be wrong, but in political beliefs historically have not driven long-term performance of the market. And blunder number 13, trying but failing to diversify. If you own 3 mutual funds, they could have 90% overlap, okay? Are you diversified into international, large cap, mid cap, small caps, value funds, okay? Are you diversified in some that pay dividends? Diversified into fixed assets, maybe some government bonds, maybe commercial lending, maybe real estate. Are you diversified into assets that provide stability? Stability is very important when you're drawing out money. If you have high volatility but high returns, if you happen to need to take money out during the downward volatility, you're taking out a higher percentage than you'd planned on. It could be 6, 7, 8, 9% because you caught it at the bottom of the cycle. Removing volatility can help your portfolio last a lot longer, and you get that through diversification. So there you go. There's 13 retirement blunders per Ken Fisher's group, Fisher Investments. I will link that chart of international stocks. I think you'll like that. And I'll list these 13 blunders for you. This is Joe out.